Let's talk about the big Indian dream, owning property. Whether it's a flat, a shop, or an office, we've all imagined earning passive rental income and living the good life. But reality, property prices in big cities are sky high, and the process is a headache. Loans, paperwork, tenants, repairs. Most of us give up, shelving the dream for someday. But what if you could own a piece of multiple premium properties? Office parks, malls, warehouses, and get a share of the rent without crores in investment or landlord hassles. Enter REITs, real estate investment trusts. REITs are like a cheat code for real estate investing, giving you the benefits of property ownership, steady income, and potential growth, but with a much lower entry cost. You don't need to be a millionaire or deal with leaky pipes at 2 a.m. This is your chance to finally make that passive income dream a reality. Let's break down how REITs work and why they might be your ticket in. So what's a REIT? Think of it as a mutual fund for real estate. A REIT pools money from many investors to buy and manage income-generating properties, like office buildings, malls, and warehouses. The REIT collects rent from tenants and, by law, must distribute at least 90% of its net income to investors as dividends. When you buy a REIT unit on the stock exchange, you own a tiny slice of every property in its portfolio. No need to manage tenants or repairs. The REIT's professional team handles everything. You just invest and receive your share of the rental income. Before REITs, only the ultra-rich could access commercial real estate. Now, anyone can. SEBI's rules ensure transparency and steady payouts. REITs make real estate investing accessible, simple, and income-focused. Why care about REITs? First, regular income. Thanks to the 90% payout rule, you get steady dividends, often quarterly. Second, affordability. You can start with just a few thousand rupees, buying REIT units like any stock. Third, diversification. REITs own multiple properties across cities, so your risk is spread out. If one property is vacant, others keep earning. Fourth, professional management. Experts handle everything, maximizing value and income. Fifth, liquidity. Need cash. Sell your REIT units on the stock exchange and get your money quickly. No massive down payments, no landlord headaches, no waiting years to sell. REITs offer a flexible, low-stress way to invest in premium real estate. For young investors, it's a game changer for building wealth and passive income. That's why REITs are your new best friend in the investment world. But REITs aren't risk-free. Their prices can fluctuate with the market if the economy slows. Rental income and dividends can drop. Rising interest rates can make REITs less attractive compared to bonds, affecting prices and payouts. REITs are still concentrated in real estate if the sector struggles. So will your investment. For example, a shift to permanent work from home could hurt office REITs. Dividends are taxed as per your income slab, and growth is usually slower than high-flying stocks. REITs are best for steady income, not quick riches. Use them as part of a diversified portfolio, not your only bet. Ready to invest? Here's how. First, open a demat and trading account. If you already invest in stocks, you're set. Search for the REIT you want, like Embassy or Mindspace, on your trading platform, and buy units just like shares. Minimum investment is usually just one unit, costing a few hundred rupees. Track your REIT's performance in your portfolio. Prefer a hands-off approach? Invest in mutual funds or ETFs that include REITs. Some hybrid or multi-asset funds allocate a portion to REITs, giving you exposure without picking individual ones. Check the fund's holdings before investing to ensure it includes REITs. Either way, you're adding real estate to your investment mix, simply and efficiently. India's REIT market is young but growing fast, with 4 major players. Embassy Office Parks REIT, Embassy, is the pioneer, with top office parks in Bengaluru, Mumbai, and Pune, and a strong dividend track record. Mindspace Business Parks REIT, Mindspace, focuses on Grade A offices, especially in Mumbai and Hyderabad, and is known for sustainability and high occupancy. Brookfield India Real Estate Trust, BREIT, is managed by a global giant with properties in Mumbai, Gurugram, and Kolkata, and a strategy for growth. Nexus Select Trust. Nexus Select is India's first retail-focused REIT, owning top malls in 14 cities, including Delhi's Select City Walk. Each REIT offers a unique flavor: offices, global management, or retail. Choose based on your belief in office work, global expertise, or India's retail boom. All offer steady income and diversification. Research their portfolios and yields before investing. These are your main options for getting started in Indian REITs. Not sure which REIT to pick? Let mutual funds do the work. Many multi-asset or hybrid funds invest in a mix of stocks, bonds, gold, and REITs and invitees. The fund manager decides the allocation, giving you instant diversification. Check the fund's fact sheet or scheme information document to see if it holds REITs. Examples include ICICI Prudential Multi-Asset Fund and HDFC Multi-Asset Fund. This approach is simple, hands-off, and perfect for beginners. The trade-off: less control over which REITs you own, but easy, balanced exposure. That's your crash course on REITs in India. They let you own a slice of premium real estate for the price of a weekend trip, with steady income and no landlord headaches. Benefits: regular payouts, low entry, diversification, professional management, and liquidity. Risks: market swings, interest rates, sector concentration, and taxes. You can invest directly or through mutual funds. Choose what fits your style. Research the 4 big REITs, understand your goals, and diversify. REITs aren't magic, but they're a powerful tool for building wealth and passive income. Start small, stay informed, and let your money work for you.